Well, welcome to our High Rock monthly video for September. I'm Scott Tomlinson, and with me on the call is Paul Tepsich, the managing partner and founder and portfolio manager for High Rock. And we're going to talk a little bit about what happened in financial markets in August and how that might have impacted client portfolios. And we'll start with just looking at how some of these financial markets traded. July was a good month. August, not so good, Paul. And the worst performing asset classes were certainly U.S. equities, global equities, and Canadian real estate investment trusts. Canadian bonds, not so much better. And by virtue of all of that, balanced portfolios underperformed or performed in a negative way. So I don't know if you have any comments, but that's the way August went.
Yeah, it sure did. Well, it looked pretty good, certainly in the middle part of the month, didn't it? And then that's a big swing. I mean, if you look at U.S. equities, and they were up 4% roughly mid-month, and then ended up down 5% at the end of the month. Pretty nasty. Yeah, more of the same. And I think a lot of that being driven by a lot of job owning from central banks, certainly the Bank of Canada and the U.S. Federal Reserve continuing to want to hike interest rates to combat inflation.
Yeah, and we'll get to that in just a second. But I think something that we focus on so that our clients can compare their portfolios. And of course, we're always open to conversations with our clients about their portfolios, but a balanced mandate we use is the iShares Core Balanced ETF portfolio. You can see that year to date, it's down close to almost 12.5%. And last month was not a great month for it either. So if you are looking at your portfolio performance, you want to have a conversation about how your portfolio is doing relative to the benchmark, we are wide open to have those conversations with you. And while we're doing that, one of the reasons that we think we've been able to outperform the benchmark this year has a lot to do with some of the work that Paul's been doing in the tactical model, and not just the tactical model, but also in some of our special mandates. Paul, let's talk a little bit about high yield, because high yield and some of the work you've been doing that for our high yield special mandate, as well as what in the fixed income and in the tactical models, have really helped mitigate some of the downside, right?
Absolutely. They do. Both the private client wealth management sector or division and the special mandates, which right now are largely focused on high yield portfolios, they do cross over. So a lot of our balanced mandates in the private client division own the same bonds as our high yield mandate clients. So they largely have been, the ones certainly that have performed so well have been in the energy space. And we've had a pretty good call on that. They've provided good yield, high yield, if you will. And contrary to the way they've traded over the last 7 or 8 years, they've provided a fair bit of stability, shockingly. But everybody knows what's happened to the price of energy, fossil fuel energy, that is, both natural gas and oil. So these bonds have done extremely well, both from a current interest, coupon interest, as well in some cases as capital gains. Specifically, Scott, in the high yield special mandate division, we have probably about 10 clients in there that continue to be invested over the past number of years. And I won't tell you how much they're up year to date, but they do have a plus sign as opposed to a minus sign. And again, a lot of that because of the way we structured the portfolio around some energy risk for the past few years. We have one client. He's got 2 high yield portfolios with us. He's unwinding a family trust, So we wanted to sell the entire portfolio, and we put it out to some of our existing investors. And one guy who is an existing, large and existing high yield investor, scooped it up right away. So we will be transacting that from one client to another. But the reason why I mention that is that although this larger client is taking this entire portfolio that was for sale, we can still replicate that portfolio. It might take a little bit of time. We can't do it in a day, but we can replicate that portfolio. So if anybody is interested in hearing more about our high yield mandate and seeing if it's suitable for your needs, I would encourage you to reach out. We still think there's certainly some value in a few of these positions that we own.
Yeah, and I concur with Paul on that. It is a conversation that we'd love to have with anybody who wants to even just begin to explore what the options are. But you know, we talk often about how we're focused on the long term, and we know that the game that the stock market became as a result of central banks and all the focus on stocks through 2020 and 2021 drove stock prices to a place where they just didn't have any value whatsoever. And that means that going forward over time, we're probably not going to see the same ability for stocks to provide return in client portfolios. So it's really important to manage the expectations for the future, and possibly the challenge is to find alternatives that will help drive portfolio returns, but are perhaps not necessarily stock market related. So that will be certainly a conversation that we're happy to have with any of our clients, or anybody who wants to introduce us to other individuals who would like to talk about investing in high yield and our high yield mandate.
And Scott, if I could just add one thing that you and I have talked about before. We don't have a chart or a table on it, but I would just caution investors in that not all bonds are created equally. And without getting too complex, there are certain bonds that are interest rate sensitive. Everybody knows that as interest rates go up, price of that bond goes down, and that is true from government bonds to high yield. But not government bonds are 100% interest rate risk. There's extremely low probability that the U.S. government or the government of Canada would default on its debt. So it's really interest rate risk. When you move down the credit spectrum and even into investment grade, that is interest rate risk. Typically between 65 and 80% interest rate risk. The other 35 to 20% is considered credit risk. But high yield largely is credit risk, not interest rate risk. So it is less susceptible to downward moves in price when interest rates rise. And some bonds have zero correlation to interest rate risk. And we own some of those bonds. So that is part of the reason why it's helped our overall performance, and obviously in our high yield mandates, but also in our balance mandates. So when people tell you, oh, interest rates are going up, I don't want to own bonds. I talked to a guy 2 weeks ago. He's like, oh, I would never buy bonds. Like, really? What kind of bonds? There are government bonds, there's investment grade bonds, there's high yield bonds, there's distressed bonds. So they're not all created equal.
So just very quickly and briefly, talk about credit quality, because I think that's something that you brought up, that's the other side of the equation. Talk about credit quality and the work that you do to try to mitigate the downside for credit quality.
The key point is to talk quickly, and I don't want to drone on, but well, certainly a lot of those positions that we own in the high yield mandates and portfolios, and in our tactical model within the balance mandates, I do fundamental analysis and credit work and run Excel models. And in there, I'm really focused on cash flow and specifically free cash flow. And then a big part of investing in high yield is doing credit work. So credit analysis and understanding how likely or unlikely it is that an issuer, a company who issued bonds or debt, is going to be able to or not be able to continue to pay the interest coupon on that debt that's outstanding, whether it's a bank loan or a term loan or a bond or even a convertible bond for that matter. So before you do equity analysis, you really need to do credit analysis because that is further up the capital structure. So I do run models on these things, and it doesn't mean we're always going to be right. We have not always been right. We've absolutely had some mistakes for sure. But on the whole, doing that work does help us. And with regards to credit quality, Scott, I mean, that's just a general theme. But as I did mention, you could think about government bonds being the top of the heap. The most creditworthy bond that you could buy would be a Government of Canada or a US Treasury bond. And then moving down the spectrum, you move into investment grade. And most of these bonds are rated by the rating agencies, which I think are a lot better now than they were back in the earlier part of the century, before the credit crisis. But investment grade bonds, you might find, as an example, the big banks would issue in there, big Enbridge and TransCanada Pipeline, big issuers. They're big companies with large balance sheets, and they have what's considered good credit quality, and they're able to issue at investment grade spreads. And then you move into the high yield space, and even in the high yield space, so they're lower rated issuers. But even in the high yield space, there are some issues and issuers that have, they're substantial businesses. As an example, I'll give you Quebecor or Videotron. They're pretty highly rated within the high yield space. And quite frankly, a lot of these energy companies now, the rating agencies are slow to upgrade them, but most of these companies are basically, if they're not debt free now or net debt free, they will be, by the end of the year or in the earlier part of early to mid 2023. That is stunning. So doing that work and looking out forward into the future, you can ascertain more about their credit quality.
All right, well, that's great. I think the important takeaway there is likely that you do a great deal of homework on the bonds of the companies that we own or on the companies that we own to ensure, to the best of your abilities, that the cash flow they're generating will be coming to pay the investors in their bonds. And as long as you're comfortable with that cash flow, then you'll hold on to those bonds. But when you see something that suggests that cash flow may diminish and may put those bonds at a higher level of risk, you may sort of question whether or not we should own them.
Yeah, absolutely. And again, we're not always right, but doing the work actually gives us a level of confidence.
Yeah, absolutely. Okay, and while we're talking about interest rates, just briefly, the Bank of Canada meets tomorrow. Consensus has it that in all likelihood there'll be a full percentage point increase. That should, once again, I would say, be pretty detrimental to anybody who has variable or floating rate debt. Your cost of debt servicing is going to go up by another third, and it is something that will be impactful on the economy, and as a result, we have to be careful as to what the outlook holds. All of this being done, of course, because inflation is still something that the central banks are fighting, and will continue to raise interest rates until they feel like they've been able to turn inflation around. as far as the global equity strategy, we will look and continue to look for value. We still have cash to put to work, but we are thinking that we may see another leg down in equity markets. We saw one leg down in June, a bounce back in July. Things have come off a little bit, came off a little bit in August, and September, October tend to be more volatile months for equity markets. So we're going to keep a little powder dry and look for that volatility. And if we get some, then we may start putting a little bit more money to work. So that will be how we sort of play with September, and we'll see what happens if we're able to add any, put any cash to work through September.
And Scott, we should probably add that some of the buying we have done, clients may not notice it in their portfolio, has been for some of the newer clients that we brought in over the last month or two as well. So they're getting more up to weight to where the rest of us are.
Right.
Tactical model. We have a couple things on the go. Actually, one I just voted on a couple hours ago. Yellow Pages, the old Yellow Pages, I guess it's technically Yellow Media. They're doing what's called a substantial issuer bid to buy back a third of their outstanding stock. And the three largest holders of this stock equate to 78% of the current outstanding shares, and they've all agreed to vote in favor of. So they only need to have 2/3 vote in favor of. So this is going to go through, and they're buying it. I think it's a bit of a usurious price they're buying it at, which is $12.58, and the stock right now is trading at 13. And in fact, we just bought some stock for some of these newer clients that have come in over the last month or two that I've mentioned. The reason being why we have to vote for it because it's going to go through anyway. But the reason to be buying the stock here is because this is a very good use of cash. The stock is trading reasonably cheaply, and the company was able to convince these three large shareholders that the stock that you will have, the 2/3 of stock that you will have remaining outstanding, should be able to go significantly higher. So actually, I was just kind of modeling out some of that before this call. So that's one thing we have on the go. We sold our position in August in Superior Plus, which is a propane delivery company across North America, mostly rural residential, some institution or some commercial. That one just didn't quite work out, and it's not like I dislike the company, but it just didn't quite work out for us. So I'm happy enough that I sold it, that we just got out of it and raised some cash. And really, Scott, that's about it for August in the tactical model. I don't really have anything else to add. Fixed income rates had continued to do well, i.e. went lower through July and the earlier part of August. And as I mentioned at the beginning of the call, with certainly the U.S. Federal Reserve jawboning rates higher, saying they're still going to continue to hike rates, all rates have given up some ground. My personal view is inflation is already, if you look at a chart, which we don't have up here, is already ticked over to the lower right-hand side, a snick, not a lot, and not enough clearly for the Fed to want to pause. But I think with just two observations, every commodity in the world, save for thermal coal, is off 30, 40, 50% over the past 2-3 months from their peak, including oil now. Oil hung in there for quite some time. I think once that starts working through the system, and unemployment rates, which are still reasonably low, are a lagging indicator. I was just reading an article on wages, hourly work hours, etc., have already started ticking lower. So I do think that this will continue. The Fed will hike again in September. I think it's the 22nd or something, 23rd, somewhere in there. they'll hike again, and then I think they pause. And another consideration for us in the markets is that they do have US midterms in November. And whether or not we believe that the US Federal Reserve Board is a political beast or not, I think it's something to consider that they would pause in front of that. So I think we've got, the bank does 75 tomorrow, and I think the Fed does 50 or 75 in a couple weeks. And then I think it's a pause. So we'll see. For now, every time the Fed or the bank speaks, and jawbones rates higher, rates go up like they did, the past couple days, including today.
All right, thanks, Paul. Well, we've given you a lot of information today, and that's a lot to digest, and it may be too much. So we want to make sure that if you have questions, want to engage us in conversations around anything, around high yield, around your portfolio strategies, we want you to get in touch. We want to make sure that we're reviewing and updating and making sure that we're doing the right thing by all of our clients. So please, as you feel you have the time, we have always got the time for you, get in touch. And so on behalf of Paul, myself, and Diane, I will say have a great month of September, and we look forward to being back at the beginning of October.